Good afternoon, everyone. Welcome to the deep dive session on the proposed amendments to the Tier 4 not-for-profit reporting standard. I'm Jamie Cattell, and I'm a project manager at the External Reporting Board in the Accounting Standards team. And I'm joined today by Carly Berry, who is also a project manager in the Accounting Standards team. You'll be hearing from both of us throughout the presentation. We'll also have some time to answer questions at the end, so please submit any questions you have using the Q&A function that you'll find at the bottom of the screen. You can also submit your questions using the chat function, and we have joining us monitoring the chat, Anthony Heffernan, who is the Director of Accounting Standards here at the External Reporting Board. So first, a quick introduction about who we are. At the External Reporting Board, our vision is that New Zealand prospers through effective decision-making for resource allocation informed by high-quality, credible, integrated reporting. What that means in practical terms is that we are the independent Crown entity responsible for developing and implementing accounting, audit and assurance, and climate reporting standards in New Zealand. What we're here to talk about today, though, are the proposed changes to the Tier 4 not-for-profit standard, which is part of the accounting standards framework as it applies to not-for-profits. The first thing when we're talking about this framework that we need to reinforce is that at the External Reporting Board, we are not responsible for deciding who has to report. That's driven by legislation. For not-for-profits, until very recently, the main way that they were required to report was through the Charities Act 2005, under which all registered charities have to prepare financial statements in accordance with accounting standards issued by the XRB. There is an ongoing review of this act, however, which is considering several issues, including the reporting requirements for small charities. And part of our proposed amendments also addresses this. We will be talking about that later. There's also been a new Incorporated Societies Act passed as of April this year, which will require all incorporated societies, except those that meet the definition of a small society, to prepare financial statements in accordance with accounting standards issued by the XRB. To give you a sense of the total number of entities, and you can probably get a picture based on what's on the slide there, between these two acts, that means we've now got over 30,000 not-for-profit entities in New Zealand that are required to apply XRB standards. Reporting by these entities is divided up into tiers as part of the accounting standards framework. This table shows the tiers as they currently stand and as they apply to public benefit entities, or PBEs, in New Zealand. And PBEs means or includes both public sector and not-for-profit entities. The framework has these 4 tiers with different standards that apply to each tier. The key difference between tiers 1 and 2 and tiers 3 and 4 is that the tier 1 and 2 standards are based on international public sector accounting standards issued by the International Public Sector Accounting Standards Board, whereas the standards for tier 3 and 4 are New Zealand specific. They were written from scratch by the XRB specifically for smaller not-for-profit entities. The one we're talking about today, though, is tier 4, which applies to not-for-profit entities with total operating payments of less than $140,000 per year. The other criteria you'll see is that an entity cannot have public accountability. While all not-for-profits are accountable to the public in some way, the term public accountability in this context has a specific meaning, and it means that an entity has debt or equity instruments traded on a public market, for example, the New Zealand Stock Exchange, or it is deemed to have higher public accountability under the Financial Markets Conduct Act. The number of entities this includes is quite small, and if you're interested in the Tier 4 standard, it's unlikely that you'd be caught as an entity within this public accountability category. And if you were, you would usually be aware of it. So for most entities, the main criteria for their reporting tier is their size. And to give you a sense of how this is distributed, as it stands for registered charities, roughly 95% of registered charities in New Zealand fall into either the Tier 3 or Tier 4 standard. And the last time that I looked, I think roughly 75% of charities are eligible to apply the Tier 4 standard. So that is far and away the majority. Why is it that we have the Tier 3 and Tier 4 standards? Why do we have these New Zealand specific things? Well, having such a diverse range of entities in terms of both size and the nature of their activities represents a particular challenge for us as standard setters, which is balancing the users and the preparers' perspectives. While the objective of financial reporting by not-for-profits is to provide useful information, preparing information always has some cost to the entity that's preparing it. So what we mean when we say that we're balancing these two perspectives is that we need to ensure that the cost of preparing information doesn't exceed the benefit of that information to users. And part of how we strike this balance is by having these 4 tiers of reporting, which allow us to develop less onerous reporting requirements for smaller entities. In the context of Tier 4, this means making the standards simple to apply while ensuring that they still provide meaningful information that promotes public trust and confidence in these small entities. And achieving this balance and getting it right is not always straightforward. What actually are the Tier 3 and Tier 4 standards, though? These standards have been applied by not-for-profit entities since 2016, bearing in mind that it was going to be smaller entities that were applying these standards, and this is particularly true again for Tier 4. The XRB took a slightly different approach to developing them than it usually would for Tier 1 and Tier 2. First is that there's only a single standard for each tier, and only a single standard in this case for Tier 4. We do have separate versions of the Tier 4 standard, one for not-for-profits and one for public sector, but today we're talking about not-for-profit. And the Tier 4 standard is cash-based, which means it doesn't use traditional sort of accounting style. It is done, or the income and expenses or the transactions themselves are measured based only on what is realized in cash, things that actually go through the bank account. To make that standard simple to apply, it was written with less technical language wherever possible, particularly focusing on minimizing the use of accounting terms. And as it reflects only cash transactions, it was designed to reduce or almost eliminate the amount of judgment that was needed to be applied by an entity. There is no need to really apply judgment to those transactions or make any estimates of things. It's only intended to also cover the most common transactions for these small entities, rather than try to cover all the possible things that they could enter into. And because these standards were brand new, we also developed and issued template performance reports and other guidance notes, which sit alongside the standards. And that brings us to the post-implementation review that we completed last year, but began in September 2020. After the Tier 4 standard had been in place for around 5 years, the XRB felt that it was timely to check on how the standards were working in practice and whether they were achieving the intended objective. In order to do that, that was why we started the post-implementation review. That covered both the Tier 3 and Tier 4 standards, and through it, we received over 100 submissions. The good news for us for Tier 4 was that we were told that it was working well overall. It was, in a broad sense, achieving its objectives. But the feedback did also tell us that there were a number of small entities, particularly at the smallest scale, that were still finding it difficult to understand and to apply. And among the respondents, there was strong support for us trying to further simplify that standard. So in order to achieve that, we're proposing several improvements to the Tier 4 standard. And those are listed on the right-hand side of the slide there. What we have is we're trying to reduce the length and the complexity of the Tier 4 standard overall. We are introducing further disclosure concessions, reducing further the requirements for the very small Tier 4 entities. We're making amendments to try to clarify and improve the guidance on service performance reporting. We are clarifying the categories for presenting cash received and cash paid. And we are removing the requirement to prepare a separate statement of resources and commitments. All of that we will go over in a bit more detail shortly. And to take us through the first of it, I'm going to be handing over to Carly, who will talk us through the overall improvements and service performance reporting.
Thanks, Jamie, and good afternoon, everybody. So we'll start off the main content of our presentation with our proposed simplifications. So during our post-implementation review, what we were told is that there are many people who are struggling to understand and apply the Tier 4 requirements and feel that it is too complex for some of the smaller entities. So to address this, we have reconsidered the Tier 4 standard as a whole and simplified the requirements and the language. This process has allowed us to cut down the standard to almost half of its original length. And it also meant removing some of the requirements and carefully considering what information users of Tier 4 performance reports needed. In some cases, we had to look back at the way we expressed the requirements and consider other ways of expressing them that used fewer accounting terms. We have refined the categories for reporting cash received and cash paid, which Jamie will discuss later on in the presentation, as well as remove the statement of resources and commitments, but retaining some disclosure requirements here. Although we feel our proposals will really help Tier 4 entities, we were conscious that the standard is still in development and that the entities raising these concerns needed some additional help now. So to that end, we also released last year a new simplified reporting template for the smallest entities, which complies with the requirements in the existing Tier 4 standard. Because this template was designed with very small entities in mind, it includes only the mandatory requirements of the standard, and at 3 pages long is much shorter than the more complete template. We will discuss what we mean by very small entities on the next slide. Both this new simple template and the original template will be updated based on our final standard. So this brings me to one of the biggest and most exciting changes that we are proposing, which is to introduce disclosure concessions for entities which can be considered small. So a small Tier 4 entity is one with total annual payments of less than $10,000 in both the current and previous financial years. This number is based on how the DIA defined small charities under the Charities Act review. This table sets out a broad overview of the Tier 4 requirements, and lines with red crosses indicate where a small Tier 4 entity does not need to disclose the information. So in summary, a Tier 4 entity does not need to quantify its significant activities as part of its service performance information disclosure, does not need to disclose the value of its significant assets, and does not need to disclose information about grants or donations received that have provider expectations over use. They also don't need to disclose information about the impact of significant events after year end, but before authorization of the performance report, and they don't need to disclose additional information necessary for readers to understand the overall performance of the entity. Small Tier 4 entities also don't need to disclose certain parts of the entity information section, such as its structure and the names of any entities it controls. So our hope is that these additional concessions will make the Tier 4 standard much easier to apply for those small entities that are finding it difficult, while still allowing for useful information to be disclosed in their performance reports. So I will now be going into a polling question, just so that we can get an idea of what you think about these proposed changes. So if you could all take a minute to respond to that, that would be very useful for us.
And if you have any questions as well about any of the things that we're offering or proposing to include concessions for, feel free to ask those in the chat. I think we could probably end that poll now.
Okay, so that's looking very positive. Certainly looks like we're heading in the right direction. I see there are some unsure responses. Of course, we have gone over this in a high level, but please take the time to look through the consultation documents and please send through any comments you have either now or over the next few months until the end of the consultation period. We are very interested in any feedback you can provide. All right, so we shall move on to service performance information. So during the post-implementation review, we heard that many preparers were finding these requirements difficult to understand, particularly the reference to terms such as outcomes and outputs. So to provide further clarification about what entities need to do when reporting on their non-financial information, we're proposing to eliminate the use of these terms and align the Tier 4 requirements with the Tier 2 PBE standards, in particular PBE FRS 48. More guidance on what can be reported is also proposed. So this slide highlights what a Tier 4 entity would be expected to disclose in its statement of service performance. A Tier 4 entity must describe what it is aiming to achieve over the medium to long term, in other words, its objectives. This information can be provided by cross-reference from the performance report to other publicly available reports that may provide this information. They must also describe the significant activities that it has undertaken during the financial year to advance its objectives. We have emphasized in the standards that an entity does not need to include a detailed account of everything that it has done, but only its significant activities. And what is significant will be a matter of judgment, as every entity is different. And it will depend on what the entity thinks is important to give the reader an overall understanding about what it has done. Must also quantify the significant activities during the financial year, but just note there that small Tier 4 entities are not required to do this. Our updated templates provide simple format examples for the statement of service performance. However, you can choose how you'd want to present this information. So for example, you can include tables, graphs, or images, whatever you feel would work best. So that now brings me to our next polling question. If you could all take a minute to respond to that, please. Okay, so again, heading in the right direction there, and again, some unsure responses. We really are aiming to make things a lot easier for Tier 4 entities. So if you read through the documents and you're still unsure, then please send us through any comments. I will now hand over to Jamie for the next section.
Thank you, Carly. So the next piece that we need to go over is the required categories for reporting cash received and cash paid. What we'd heard was that some preparers were finding it difficult to classify their cash received and paid into the required categories. So there was a list of 4 categories. You were required to allocate all your transactions into one of those 4 at a minimum. We'd heard that the difficulty of making that kind of classification was resulting in some preparers still presenting full lists of all, we say revenue and expenses there, that should say cash received and cash paid based on their trial balance. It basically meant that we ended up with what was known as a statement of receipts and payments going over several pages rather than being contained to a single page and providing a good high-level overview of the entity. In response to these difficulties, we are proposing to remove the receipts terminology. That was another area that was commented on that people found difficult to understand. We'd heard that where people were saying receipts, they thought it meant physical receipts as in a receipt book rather than receipts as in cash received. So we're removing that and changing the name of the statement from the statement of receipts and payments to just the statement of cash received and cash paid. We're proposing to increase the number of required categories. While that might seem somewhat counterintuitive, our view is that having these more clearly defined categories should make it easier for people to know which bucket to put the transaction into. But because we're also increasing this number, we're proposing to remove the option to disaggregate these categories further on the main statement of cash received and cash paid. We are still allowing, though, an entity to provide more information in the notes if they want to. It won't be required to do further disaggregation or further breakdowns, but you can if you want to and you think that that's useful. Of course, that raises the question of what the new categories we're proposing actually are. The table on this slide shows the proposed new categories for the receipts in the Tier 3, Tier 4 not-for-profit standard. As you can see from the categories we have here, the new ones are highlighted, but most of it comes from splitting apart categories that already exist. We've got donations, fundraising, and other similar receipts, which is being split, and also receipts from providing goods and services is being split. The donations, fundraising, and other similar receipts category, we're proposing to split into donations, koha, bequests, and other fundraising, and grants received, because these are two slightly different ways of receiving cash. Receipts from providing goods and services, we're proposing to disaggregate into funding from service delivery grants and contracts, and sale from goods or services as a commercial activity. This split's a little bit more significant, and I will touch on it shortly. And it's also important just to reinforce here that even though we've got these categories, you'll still be able to relabel them using terminology that's more appropriate for your entity. These are just the names that are given in the standard. You will still be able to give more detail in the notes. And if a category that's in this list doesn't apply, you don't have anything that goes into it, you can still ignore it and just choose not to report that. This slide shows the proposed new categories for cash paid in the Tier 4 standard. Like the cash received categories, the new payment categories that we're proposing come from disaggregating existing categories. So we are splitting volunteer and employee related payments into employee remuneration. So this one is just the amounts that you pay directly as an employer to an employee for their work, and volunteer and other employee costs. We're also proposing to disaggregate payments related to providing goods and services into expenses related to payments related to the sale of goods and services as a commercial activity, and other costs related to the delivery of entity objectives. And again, can still rename, can still provide more detail in the notes, and you can still ignore those categories which don't apply. Of course, we've got these two new things. So what do we mean when we're talking about commercial activities and service delivery grants? For commercial activities, which is a new concept, we are proposing to add a definition which really means transactions where goods or services are sold on commercial terms for the primary purpose of generating a profit. The profits are then used to fund an entity's not-for-profit purpose. So sells something to make money, which it uses to deliver its normal not-for-profit goods or services or activities. This will require some judgment, and really it kind of goes on a gut feeling idea. What is the entity's intention for doing this? And a good example of this would be an entity that has a dedicated site to produce and sell baked goods, like a commercial bakery. That's the kind of activity that we're talking about there. The other new category is the service delivery grants or contracts, by which we mean funding that is really, or appears to be in substance, a contract for the delivery of goods or services to either the party that's providing the funding or to third parties. So think of a grant that is given to an entity to provide a specified number of counseling service hours to beneficiaries. That is really less of just a payment to support them in general and more of an agreement to provide specific services for funding. That is a very quick high-level overview of what we mean by that. And if there are any questions about that, please do put them in the chat. But I believe we have another polling question now, which I will just launch. And it's whether you think the proposed categories are suitable and would capture the majority of a Tier 4 entity's transactions. And for reference, I will quickly flip back to the categories. Okay, so it looks like we're getting a few more no's coming through on this one. I would actually be really interested to know in what categories you think would need to be added or removed, whether you think that some of them are inappropriate, whether you think we're not going far enough. Please do send us a submission if you feel like that, or you can also just tell us in the chat or in the Q&A. We would definitely be interested in hearing your views on that. And that brings us to actually the last significant change that we are proposing to the Tier 4 standard, which is the requirement to prepare a statement of resources and commitments. We were told that it was confusing to have to do this statement because the Tier 4 standard is cash-based, and the statement of resource and commitments seemed like it was asking you for some stuff that was really accrual, asking for assets and liabilities. Although we agree that the statement of resources and commitments as a separate statement is not necessary for entities applying a cash-based standard, we do still think that Tier 4 entities should provide some information about the assets and the liabilities that they have because it's useful. It will affect how a reader interprets the performance report that they get. So we're proposing to remove the requirement to prepare the statement of resources and commitments, and instead that we are proposing that an entity will only be required to disclose information about the significant assets and significant liabilities that it has in the notes to the performance report. For reference, what we mean when we say significant is that if the disclosure or information about that item, whether it's financial or non-financial, could influence a reader's understanding of the overall performance of the entity, then it is significant. In the majority of cases for a tier 4 entity, you can probably also describe this simply as a large asset or a large liability, which is the main reason why something would or would not be significant. And that's really reflected in this slide here, which is an extract from our new template. It is the note for significant assets, and the suggested assets that it has in that list are significant amounts that are owed to the entity by external parties, so money that is owed to it, whether it has any land or buildings, large fixed assets, or whether it has any large investments, which could be things like shares that it holds, or bonds, or units that it has in managed funds. And then we have a catch-all there for anything else that's significant. It's asking you for a valuation of that. That value is really the entity's best estimate, or really the best source of value that it can have. It's not requiring it to be something that is very robust. It's designed to give you an overall picture of what the entity has available to it. And that's really reflected in the fact that for the small entities, small tier 4 entities, the requirement to provide a value for those things is not there. They only have to provide a description of the significant assets and liabilities that they have available to them. And by significant liabilities, this is the example that we have in the template for that note disclosure. So large amounts that they owe to other people, loans or borrowings, usually that's going to be something from a bank, other amounts that they owe to external parties. So you can think of things that they might have purchased on credit, and any funds that they hold on behalf of others. We were told that it's actually relatively common for entities to temporarily take money that they hold on behalf of others and sort of transmit those payments, not in the same way as, say, like a bank would do, but more as something like a club that's organizing a group trip, that sort of thing. So we wanted to make sure that that was reflected in there as well. We aren't, though, including most low-level commitments like an ordinary set of accounts payable or anything like that. That brings us to the final polling question that we have for today, which is really whether you agree that a tier 4 entity should still have to disclose some information on the significant assets and liabilities in their performance report, or whether you think that that should just be struck out entirely. So a bit more positive on that one, which is great. For those of you who said that they shouldn't have to provide that information, we would be very interested in your view as to why. This was a very popular area, obviously, that people would comment on. And so we really want to make sure that we understand any objection that people might have to disclosing this information. And that actually brings us to the end of what we're talking about for Tier 4 today. But that gives us plenty of time to answer any questions that you might have. But before we look at that, I just want to highlight that if you go to our website at xrb.govt.nz, you can make your submission. We have several different ways that you can submit to us. You can either write out a formal submission, which you can submit via the website, or you can email it to us, which isn't shown there on that slide, but it should be on a slide later, accounting@xrb.govt.nz. And also on our website, you'll find feedback forms that we have uploaded, and you'll find the full consultation documents that go through all of this and other changes. You'll find some at-a-glance summary documents, and you'll find the exposure draft, so what the Tier 4 standard is going to look like. For the Tier 4 standard, we've also got drafts of the new template that will go alongside it, including the simple template for small Tier 4 entities. You have until the 30th of September this year to submit. So that is when the submissions close, after which we will consider all the feedback we get. And that brings us to questions, but I'll flip to the next slide just so you can see all of our socials. You can follow us on LinkedIn. You can subscribe to newsletters at xrb.govt.nz, and there is our email address. So I believe we've got some questions, although it looks as though Anthony might have been busy working away in the background answering those questions. So I might ask Anthony if there's anything that he thinks we should be speaking about.
Thanks, Jamie. It's probably useful just to talk about how we see this aligning with the Charity Services annual return, if you want to comment on that.
Yes, thank you very much for that reminder. I was supposed to talk about that when we were looking at the minimum categories. So as those of you who have been following the modernisation of the Charities Act will be aware, there's been discussion a lot about the reporting requirements that apply to small entities. We've been working very closely with DIA throughout this process and getting their feedback on the standards and areas that we can improve. So a part of our work, particularly with the policy team, was talking about these reductions in the reporting requirements for small entities. But the other part that we've been talking to Charity Services separately about is the alignment of these requirements with their annual return forms. Everything that we're proposing to do with categories here will be reflected in those annual returns. So there won't be a need to recalculate. And we're also working with them on developing a way that you will be able to use the annual return form as a means of meeting the XRB reporting requirements. So you won't have to do it twice. There will just be the one instance.
It's just a question, Jamie, about when we expect these changes to come through. Did you want me to have first go at that, or?
I think you might be better placed to answer that.
So let's be open for consultation until September, and then we'll look to bring in the changes as quickly as possible. As soon as we make those changes, they will be available for early adoption. So for those entities that really like what we're doing and can see we're looking to make life a bit easier, that will be available immediately. So that may not be till the end of this year, just to allow us to get the feedback and for the board, the New Zealand Accounting Standards Board, to analyse the feedback received. But as soon as it's issued, we'll make it effective immediately. But then there'll be a transition period. And this is all things we need to talk through. No final decisions are made, but we might give it a 2-year transition period until entities are required to adopt the new requirements. But because they're going to be less in many respects, I'm not seeing that as a major issue.
Yeah. And of course, you will still be able to adopt it whenever you feel you want to. It won't be 2 years until you're allowed to. It'll be 2 years until you have to.
Yes.
Yeah.
Just some questions coming through about funders and the information that funders need. And I'm picking up maybe some concerns that the reduced Tier 4 reporting requirements will not provide everything that's expected by funders. And I think one of my responses to that is to keep in mind that Tier 4, the standard, is setting minimum reporting requirements. Once you've met those minimum reporting requirements, you can, of course, add more information as much as you like. So if you've got specific information that our funders are looking for, you can add that to your Tier 4 report. If the funders are really looking for, at least what I would call a balance sheet of recording all your assets and all your liabilities and having that balance in the way that works under traditional accounting, then my personal view is I'll be encouraging you to move up to Tier 3, which is full accrual reporting. Yeah, this is a cash-based standard which has its restrictions, limitations, probably a better word. But it's setting minimum requirements for those charities that are seeking to comply, but there may be a non-accountant. They understand that they need to track the money coming in and out of their bank account, and they should be able to provide some minimum information about that.
Yeah, yes. My understanding as well from my previous life is that there were a lot of entities that were being asked by funders specifically to move up to Tier 3 because they wanted that balance sheet. And we can't write a standard that's always going to be all things to all people. And so this was intended to meet the needs for these very small entities. But there were always going to be some people that might have needed different or more information than it could provide. Okay, so it looks like we're not getting any other questions coming through. Of course, if you do have any other questions that have come up or that you think of after this, you are more than welcome to send those through to us as well at accounting@xrb.govt.nz, and we will come back to you with an answer. So if there is nothing else for today, I will let you all go early. So thank you very much for coming along today, and we look forward to hearing your submissions. Thank you.